Today, we delve into the recent legal troubles of a billionaire, Joe Lewis, whose conviction stems from a surprising twist of market manipulation. Contrary to the usual narrative of bilking retail investors for the benefit of hedge funds, Lewis finds himself behind bars for a different reason, stealing from the wealthy to aid the less fortunate. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads, and also enter our giveaway. But everyone remember, this is not a financial advice video. In a tweet from Frank's Place, it was revealed that Joe Lewis, a UK billionaire and owner of the Tottenham Hotspur Football Club, pleaded guilty to insider trading in a US court. The allegations implicated Lewis in passing confidential information about his companies to a network of individuals, including his private pilot, friends, personal assistants, and romantic partners. According to US authorities, this insider trading scheme led to millions of dollars in profits. As part of a deal with prosecutors, Lewis admitted to conspiracy and 2 counts of securities fraud. The crux of the matter lies in Lewis exploiting his access to corporate boardrooms between 2013 and 2021, sharing insider information with his contacts, who subsequently made substantial profits in the stock market, often at the expense of hedge funds and other institutional investors. Contrary to the typical scenario where the rich exploit the poor, Lewis' case is unique as he stands accused of stealing from the affluent to assist those less privileged. It's a departure from the conventional narrative, shedding light on the complexities of financial crime. While on a tangential note, a recent Bitcoin documentary highlights a case where an individual pilfered millions from everyday Americans and retail investors, yet received no prison time and was not required to return the ill-gotten gains, which were cleverly stashed offshore. This contrast in legal outcomes underscores a perceived leniency towards those who defraud regular individuals compared to the stringent actions taken when the situation is reversed. According to a U.S. attorney, Joe Lewis' plea deal includes the most substantial financial penalty for insider trading in the past decade. His company is set to pay over $50 million in financial penalties, a figure far exceeding the illegal profits generated through insider trading. This juxtaposition raises questions about the disparity in penalties, especially when major financial institutions in the United States often incur relatively minor fines for substantial illegal profits. Kristen Shaughnessy brought attention to Interactive Brokers, a case where they faced fines for naked short selling. Despite their involvement in more than 300 failed to deliver trades and thousands of instances of illegal shorting, the fines imposed on Interactive Brokers were relatively minuscule. This prompts a reflection on the effectiveness of regulatory measures and the need for a more robust system to curb financial misconduct. Crystal Ball's tweet alludes to Gary Gensler's alleged focus on aiding hedge funds and preventing squeezes rather than enforcing regulations against practices like naked shorting, spoofing, dark pool activities, and stock bashing. This prompts a broader consideration of the SEC's role and its effectiveness in tackling financial crime over the past 3 years. A parallel narrative emerges from China, where a convicted bank manager has been sentenced to life in prison for financial crimes. The contrast in the severity of punishments highlights the different approaches various countries take in addressing financial misconduct. The South China Morning Post reported that the convicted manager had to relinquish both illegal gains and personal assets, reflecting a more stringent stance on financial crimes. China's recent move to restrict short selling of stock index futures further emphasizes the global efforts to combat illegal shorting practices. Hedge funds in China have reportedly received warnings against reckless short selling, especially the naked short selling conducted for speculative purposes. China's stringent measures to ban short selling in stocks, options, and now index futures aim to stabilize the stock market and encourage recovery in the face of a significant downturn. Kristen Shaughnessy's observation on the impact of China's short-selling restrictions on its equities market reinforces the idea that banning short selling can lead to a substantial rally and proper price discovery. Drawing parallels, the discussion shifts to the potential outcomes if short selling were banned in the US, particularly in the context of AMC. However, doubts arise due to the perceived alignment of the SEC's interests with hedge funds, creating skepticism about the implementation of such measures for fair market transparency in operation. John Biarda's remarks shed light on the reluctance of FINRA to release certified aggregated audited share counts for MMTLP, implying potential complicity in favor of hedge funds and institutions. The absence of transparency raises concerns about the extent of financial misconduct, not only in MMTLP, but also in other stocks like AMC and GameStop. In summary, the case of Joe Louis highlights a unique instance where a billionaire faces legal consequences for stealing from the rich to benefit the poor. The broader discussion encompasses the disparities in legal outcomes for financial crimes, regulatory effectiveness, and the global efforts to combat illegal short selling, with a focus on the need for fair market transparency and operation. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.